Quick disclaimer, these discussions are intended for education and informative purposes. They are not to be used as legal advice. Welcome back to the 256 Investor. Today we pick up with part 2 of our conversation with Luke Hayes with IPX. I've had so many investors divest from Denver, Seattle, California, because they sell a property that's $850,000 and that's a single family home. It's not a great rental rate that they're getting, but they can sell that and they can purchase 4 or 5 properties here in Alabama.
They can.
And you're getting better rental rates
and
it's
lower
just
property taxes.
lower property taxes. Everything about it is better. That's the most common. Is you can't exchange, like you said, one for multiples.
You can. So if you sell for $800 in Denver, you could buy 4 $200,000 properties in Alabama. And what do you get out of that? Well, you get diversification, right? That's another part of investment 101. You don't want to put all your eggs in one basket, right? I probably use 1,000 grandma terms, I feel like, day in, day out, but they tend to hold true, right? Those old sayings, there's a reason people remember them because they tend to hold true even when our world kind of changes in that regard. So diversification is a huge factor.
Vacancy really hurts when you have one property.
That's right.
And when you have 4 and 1 out of the 4 is vacant, you're not going to feel it as bad. So it just makes sense.
That's right.
To have more.
Now let's use yours. Let's say that person selling in Denver had a loan of $400,000. So they netted $400. Okay. Actually, let's change it. Let's say their loan was $200,000. So they netted $600,000. What they could do is they could buy the first 2 properties all cash. So a lot of people think, okay, well, I got to prorate the debt. Not true. No, you can, if you're buying multiple properties, you can buy some all cash and then some with the remaining
cash. You just got to exchange the value of the debt.
That's right. Well, or come up with outside cash. Right. If you don't want to come up with outside cash, you're going to have to figure out and probably get another loan. But if you bought 4 properties for $200 each, 2 of them could be bought all cash, and then the other, maybe the third, you could supplement a little bit with your own cash, maybe use like $150 in the exchange, right? Come up with $50,000 for the difference. And then the last one would be the only property that you put a loan on. So that would be that's a classic example, right there of why Alabama, Tennessee, all of the Southeast is filling up, right? Every new draconian policy that comes in states like, California, New York, which I'm not saying they should change their politics because it's great for my book of business, right? No, I feel bad to some degree, but I think almost everyone can agree, even, if you're on different sides of the aisle, that, in a perfect world, you want to have as much as your money, your hard-earned cash, to reinvest. So whether or not, you're fine with a California state tax, I would say the numbers say otherwise, right? Because we have people flooding from California to Tennessee, Alabama, Florida, but at the minimum, because all 50 states recognize the 1031. There was one holdout. It was Pennsylvania, but we
I never would have guessed.
We made it. We pushed them so that they recognize it. So all of the states recognize the 1031. So, it's not just the federal, it is state tax. It can be city tax too, right? Various cities. But it's a big factor. I'm not surprised that you have a lot of clients from that area. I have a lot of clients as well.
Well, they're usually exchanging their property tax for one property that's going to equal 4, the sum of 4 different homes property taxes in Alabama.
Right. And the other goal for those clients is they see, let's take Huntsville as a great opportunity, right? In terms of future growth as well. Yeah, sure. Maybe Denver, $800,000 for a single family. But that's usually because Denver has had so much growth over the years, and now it's become a little bit stagnant. If they thought that Denver would grow to $1 million in a year, they would probably keep their property. But they're thinking, well, yeah, I might get 825 next year, but I'm getting crushed, with all the various tax I'm having to pay, maybe the city of Denver is difficult, right, from a landlord-tenant relationship and some of the restrictions they impose there. So, I want to get out of there. We've already hashed that. But Huntsville, maybe 5 years from now, Huntsville might double in value. My property's there. So if I buy 4 properties for $200, I'm kind of gambling to a degree, right? I'm making an educated assessment that Huntsville will grow at a faster rate as well. Those are your two kind of growth factors. You want to get as much ROI, which is basically just based off of you renting it and you paying, your costs associated with having the property, and then you have that hidden growth, right? That appreciation growth that I think a lot of people don't, like me personally. This is not 1031 Luke. This is just Luke Hayes, the man. A lot of people I think don't factor in the hidden appreciation growth and the value of that. Just because you might be losing money on a property, technically on a month to month based on just pure cash coming in, cash going out. If you're in an area that has significant appreciation growth, you are capitalizing on that gain. And through the 1031, you're never going to pay tax on that portion, right? You're going to pay tax on the rent. You take depreciation, but it's kind of capped to a degree. But not on the appreciation gain. So let's talk about how the adjusted basis works, what happens, why it's a deferral. I think it's a pretty easy explanation. And then let's talk about like in-game strategies.
Yeah, I want to cover.
Oh, yeah, sure.
I want to clear this up. I'm going to read from your booklet one last time.
Yeah,
I'm going to bore you one last time. Like-kind exchange can mean a lot of different things. I'm going to read some of the examples that you've got. Following are examples of qualifying properties that could be exchanged: raw land or farmland for improved real estate, oil and gas royalties for a ranch, fee simple interest in real estate for a 30-year leasehold or a tenant in common interest in real estate, residential, commercial, industrial, or retail rental properties for any other real estate, rental ski condo for a 3-unit apartment building, mitigation credits for restoring wetlands or other mitigation credits. Now, have you ever exchanged wetlands for other mitigation credits?
Sadly, yes. I've done all of those. I've had people buy parking spots. I had a person buy a parking spot at the Four Seasons in San Francisco. It was a disgusting price that was paid for that, but it was actually, he sold it, so he was on the good side of that. But I've had people buy boat slips. It's
one of the biggest misconceptions is that if I sell this single family or this duplex, I have to replace it with a duplex.
Right.
When farmer sells the farm, he doesn't have to replace it with a farm.
Right. Yeah. I'm kind of baffled why it still is like kind, because it's the wording can be confusing. Again, I can't complain too much, otherwise I wouldn't have a job. But like kind doesn't refer to the type. Right. Okay. Any type of property can qualify. Any type. So if it's dirt, it can qualify. That's why that list is really kind of small and compared to what's really eligible, because if you're looking at something and it's dirt, it's categorized as real estate. All it has to be is categorized as real estate, because you can't buy, things outside of real estate with a 1031. It's how you use it that will determine whether the IRS considers that like kind. So what does that mean? Well, again, I think it's easier to tell you what isn't eligible. There's really two main things. I mean, there's certain minor details that cause things not to be eligible, but there's really two main things I see people do that don't qualify for 1031 treatment. Flips and developments, unfortunately, those are non-starters. So properties you strictly hold for their resale value. I'm a builder. I buy properties. I build the new house. I immediately sell them. Those are considered inventory. You're in the business of flipping. You're in the business of developing the properties you have, almost like clothes for a clothing store. That's your inventory. This is your job. A lot of people that are flippers or developers, I've seen the misconception of, at least if I own it over a year, I get a reduced tax liability. That's not true, because you're taxed at ordinary income, right? The fact that you've owned it, it's not considered, a capital gain investment. So flips developments are not eligible. And then personal use, people's primaries, you can't do 1031s on. Now we'll discuss a better option, right? I'll give you, and you probably have discussed in the past, it's probably the best thing the IRS offers. But primaries and then second homes. Unfortunately, I have many clients that have lake houses, beach houses. I had a conversation the other day with a very sweet couple. They had a mountain home in North Carolina, but they never rented it. They didn't go there much, but their kids went there, and the IRS considers that personal use as well. So, personal use will disqualify. So you really, if it's a structure, if it's a residential property, you need to have rental income to qualify for a 1031. Doesn't matter what type. It could be long-term, month-to-month, Airbnb style, but you need to have rental income and you need to not use it much personally at all. So there's a specific guideline which we could potentially cover.
What kind of holding period?
Well, to qualify for a 1031, there is no holding period. So there was almost a 2-year rule enacted in '89, but it never it never passed. So some CPAs use that as a conservative basis for a 2-year hold. I think most CPAs would say a year and a day. Why is it a year and a day? Because that gets you in the long-term capital gain status. But I've had people do 1031s on a 8-month hold, a 7-month. It really comes down to two things. One, their own risk assessment. We always tell people that, to get in touch with a CPA or tax advisor. So, if your listeners or viewers have investment properties, a lot of them probably have CPAs, but there's a reason why CPAs exist as well, right? They pay for themselves and they get you out of trouble. But it's basically, can you make the argument that you came in with the intention of holding it long term, right? I came in thinking I was going to hold this maybe multiple years, but for an unsolicited offer or a change in zoning laws after I acquired, or a variety of political, something, new ordinance passed. It could be a variety of different things. So there is no official holding period. Now I teased everyone about the primary. So the primary residence, right, is not eligible for a 1031. You live in your home at least 2 years, you get the primary residence exclusion, right? The 121 exclusion. It's actually 2 of 5.
Yeah,
so
24 months out of the past
that's
60
right.
months.
That's right. 2 of 5. So you can, live there 2 years. You can move out. You can rent it. And then year 5, you would be eligible for both a 1031 and the 121.
Yep.
So, we have California investors. They bought their homes in the 80s for $300,000. Now it's worth, $2.3 million. They're capped. You're capped at $500 if you're married, or $250 if you're individual on the tax-free exclusion. But if you move out and rent it for a couple of years, you could 1031 the remainder. So that's a kind of a nuanced approach that some people use. But a lot of people will call me and they say, well, I've only lived in this primary 1 year, right? I haven't made that 2 of 5. So can I do a 1031 as a backup? The answer is no, right? The personal use has knocked it out. So I would say 1031s is rental or passive income an absolute. It's not an absolute, but if it's a structure, you probably need to have it, and really the only exceptions would be like raw land. People tend to just own land for its appreciation value, and that's considered, like kind investment or business use intent.
All right. We should clarify, there's no checklist that you work through. It's not like the IRS is checking these boxes to say you're good to go. Like we're doing this exchange, and then
we hope for the best,
clear it up. Right, we clear it up
Yeah.
with the IRS on the tax return. We're not like going through this in again checking boxes with the IRS. Like,
and to a degree,
no one's going to stop you. No entity is going to stop an
100%
individual
true.
from doing an
And
exchange.
to a degree, that provides a potential layer of opportunity, I would say. Like some people make kind of those 50-50 judgment calls. Now, I tend to think it's not wise to just say, well, what are the odds of getting audited? They're low, but they're not zero, right?
Yeah.
And there's plenty of people that could attest to that, thinking that they were zero. So, yeah, again, what's another old saying? We hope for the best, plan for the worst. So we have to assume, right, that every exchange will be audited. That's why we want to, follow the timing aspect, follow the ID rules, everything associated with the 1031. But you're right. No, there is no official checklist of I did X, Y, and Z, so therefore it's an absolute. Now, if you've rented it out and you've owned it over a year or over a couple of years, I would say there's no doubt, right? There are what we call safe harbor revenue procedures that outline kind of what the IRS will look at, and they won't challenge you if you follow those rules. So it's kind of appropriate to explain for second homes. So if you have like a lake house or a beach house and you have a lot of gain and you're thinking, well, what do I need to do to get it eligible for a 1031? The IRS, they really only care about the last 2 years. So the last use is the most important from the IRS's perspective. They don't care what you did with it 20 years ago, 19, 18. They don't really care what you did 5 years ago. They care about the last 2 years of ownership. And the look back period really starts date of close of the sale. But what they want to see is 14 days or more of rental income. So not much, 14 days, that's not too bad. But they also want to see 14 days or less of personal use. And personal use encompasses you and any related family members, and even, I guess, technically friends, that their personal use counts as your own. Now, you can rent to a family member, but they have to be living there. So we have many clients that have properties in college towns like, Tuscaloosa or Auburn or Knoxville, right? And the key is whether or not, the child has been paying, or really more importantly, the parent has been reporting the rent, right? You kind of have to treat your family like an unrelated third party, or at least that's what the IRS wants you to do. But ultimately, yeah, those are kind of the two things. But like kind is very broad, and that's pretty advantageous as well for the taxpayer.
We should back up and mention that just very basic rules. You do have a 45-day window to identify the replacement real estate, and 180 days to actually close on the replacement.
Correct. I kind of cringe when people say like 6 months. It is 180, and the IRS will tell you it's 180.
I said that for a reason.
Yeah, for sure. If your 180 ends on a Sunday, do you get the following Monday? You do not, right? If it ends on a holiday, do you get another day? No. So it is absolute. The 45, 180, those times they run together. They run concurrent to one another, and they are strict calendar days. So, if your exchange sells beginning of December, you're thinking, well, I got a lot of holidays. Yeah, that's kind of unfortunate, but it is what it is, right? You got Christmas, you got, New Year's, all these things. IRS is unforgiving. So it's pretty easy to determine when your 45, 180 is, right? Because it is strictly calendar days. Now, what happens during the 45? Well, during the 45, all you have to do is fill out a form just notifying the qualified intermediary of a list of properties that you're considering.
And I think this is the most confusing process for most people.
Sure.
Is how many you can identify and the percentage. You're going to have to clear this up. This is always the most confusing
I'll try
part.
And simplify it. I tend to tell my clients, just don't necessarily worry about the form until you get closer to the 45th day, meaning up until the 45th, every property in America is available. You can openly make offers, get under contract without identifying first, right? The goal should be to fill out the form once, measure twice, cut once. Yeah, exactly. And, the goal really should be to almost not even do the ID form because you've already closed your property, right?
In a perfect world, we would have already identified the replacement properties and had at least a verbal agreement before we ever sell.
Right, it goes back to
property.
Multitasking, right? The time before you close is really the time that can and should be utilized to get your ducks in a row, get your purchase under contract, not just looking at them. People with the best success rates doing 1031s, they typically sell and buy within the first couple of weeks. They're proactive. And so, how do you do that? Well, contingent offers are obviously a way to ensure that. Now, those aren't as attractive, but I think they're being looked at more and more, right? In terms of you can potentially drag out your close date on the sale. So I've had some clients, and I sometimes recommend like an honor before on the property you're selling. So instead of doing a traditional 30-day escrow, you do a 60-day with the option to move it up. Now that would take a willing buyer, but I think most buyers are a little bit flexible on that. So, the clock does not start when you list it. It does not start when you receive offers or accept offers, get under contract. It starts when you close. So every day you can kind of push out the sale closing gives you another day to continue to search. Right. That's why when people I work with have delays in their sale, I mean, they're never fun, and there's always the fear that, oh, this is going to fall through. But if you don't have a property picked out, it's not that bad of an outcome because it gives you more time to locate. So that would be the first thing I say. But once you get to the 45th, yes, at that point, you got to make a decision. Now, really, the first decision is whether or not you should even continue, right, with a 1031. We follow our own set of guidelines. We as the qualified intermediary, they're called G6 restrictions or U.S. Treasury regulations that all QIs must follow. And when the money goes in the account, we do not send it back to you. If you called us next day and said, I don't want to do this, actually, I changed my mind. We have to wait until after your identification period expires at a minimum. Now, we can obviously send money for a closing or earnest money to secure a contract at any time. We typically like to have a couple of business days in between sell and buy just to ensure fund availability, right? But we're ready to go on a purchase almost immediately after the sale.
Yeah.
But in terms of getting the money back to you directly, we have to wait till after the identification period expires if you don't identify.
Right. In a 1031 exchange, the seller never gets the proceeds. It's
That's
not
right.
like they get a check and then they hand it to the QI.
That's right.
The money goes straight to the QI who has an interest in the sale, correct?
Yeah, basically,
The seller will fill out a form that says the money's going
Mm-hmm.
to the QI.
You assign the benefits of the contract, i.e. the cash, to the third-party intermediary. Back in the day, you used to have to change the contract to show the qualified intermediary as the seller. Nowadays, you just do direct deeding. Our documents are all done via DocuSign. The other party has to be notified of the assignment, but we don't require a signature.
No signature. It's really easy to do. It's a short form. It
Usually
really
they get
adds nothing to the transaction.
Usually they get it day of the sale, the buyer, the other
right.
side. And they're like, what is this? And it doesn't really matter. It's like
Right.
we're notifying you that the seller is exercising their right to do a 1031
Yeah,
exchange.
I just want to make the point that the seller never gets the funds.
They never get the money.
Funds go straight to the qualified intermediary to hold.
And that's another important thing, right? You use a small company that charges you, and let's say they don't have anything nefarious going on, but if they're a victim of wire fraud, which is becoming much more prevalent with AI, I mean, I can't tell you, some of the workshops our company's having, some of the precautions, we're putting new implementations in place. You always have to at least keep up with the fraudsters. You used to be able to tell by sometimes broken English or, just grammar issues. I mean, nowadays that's just not a good way, right? I've seen many people, if you have a Gmail or
the signature would be copied and you could tell it was a little bit blurry or something was a little bit different about it.
I mean, we could probably have a whole conversation about, wire fraud, AI in general, pros, cons, but I don't even know where I was going with this, but ultimately, oh yes, yeah. So what separates us? Our accounts are segregated, direct deposit bank accounts. So everyone's file is completely separated from every other file. We have $100 million fidelity bond insurance, $50 million corporate guarantee insurance policy that's applied to every exchange, $30 million errors and omission. One of the highest, if not the highest, levels of high bonding and insurance in the industry. So that security is really a separating factor. We don't use local banks. We use money center banks. I don't know for sake of the podcast, but you would know all the banks, that we use. I want to keep myself out of trouble in terms of any private information we have. I don't necessarily think that's private, but or confidential, or should be. But money center banks. So these are banks with institutions all across the U.S., frankly, the world. Their deposits are in the billions, sometimes trillions. We are a little bit of a bank ourselves, right, in terms of holding clients' funds. So, our role really is to make sure that you're aware of the rules and of your money security. Our role isn't necessarily finding a property for you. Now, I'm a great referral source, right? I have about 13,000 contacts in my phone at this point. It's growing every day. I try and save every person. It's probably the OCD in me, but great referral source. But yeah, our role is protect your money, make sure you are aware of the issues, but it's ultimately up to you to decide, as you pointed out, what to buy. So we've gone all the way around going back to the ID, right? So by the 45th day, if you identify and the 45th comes and goes, and you call on day 50 and you say, oh, I kind of listed a property just to list it. Well, now I want, it didn't work out. Well, we have to hold your money till the exchange period expires. Now, that's right. All of our accounts are interest bearing, and all the interest does go back to the client, but there are a number of limitations that come in, and we're not, we're not an investment company, right? So the interest rate is not going to be comparable to like a money market account on that. And so the first decision is, whether or not to continue, right? If you want to identify, the most popular rule is the 3 property. That lets you list 3 of any value. Very simple, very popular, and that's it. That's literally it. So
no other strings attached. You just identify 3.
3 or less, high or low as you want. You can close on any combination. So using my 500 example, you could do 1 at 600, 1 at 400, 1 at 500. You could close on all 3, 2 or 1. So 3 or less, high or low as you want, any combination. Now, it does need to be site specific. So if it's a condo, you got to put the unit number. I've had some people, can I put the condominium address? Yes, you would be eligible to buy the entire condominium, right? But if you want to buy
it is very specific. And I've done this before,
right,
because condos are very popular when you're selling a single family and you can buy 3 condos. you have to get it down to the exact address, the unit number, the very specific address. So
Yeah,
it
a
can't be
member
a
of
vague.
our general counsel, I think, said it, and I've stolen his line. It needs to be specific enough where you could give the form to a person on the street, just a random person, and they could look at that. Now they would probably use MapQuest or whatever, but they could yeah. I'm dating myself. Apple Maps, whatever you want, Waze, right? And they could go to the property that you're trying to buy. They could literally be standing on it. So, that's how specific it needs to be. If it's land, we need a legal description or parcel number. Yes. But 3 of any value. If you want to list more than 3, you're allowed to, but you need to be very careful. So once you list above 3, then the total value cannot exceed 200% of the sale. So if I sell for 500, 200% of that's $1 million. So if I list 4 or more, the total value cannot exceed 200% or $1 million, right? Mm-hmm. So if I list 5 properties at $150,000 each, 5 times 150, $750, that's below 200%. So I could close on all 5, 4, 3, 2, or 1. Basically, by complying with the 200%, you keep your options open to close on any combination of what you listed. Can I break the 3 and the 200%? Yes. But if I do that, I now have to close on 95% of what I listed to have a valid exchange. It's pretty much a catch-all provision. Like real world, it's an all or nothing. Unless I close on all 5, all within the 180 days, I won't get any 1031 benefit, even if I followed all the other rules, right? Buying equal or greater, reinvesting all the cash. In my opinion, I don't know the exact reasoning, but reading between the lines, the IRS, one, they don't want 100% success rate, right? If they did, they'd let people do it on their own. They give you a couple of years to reinvest, and 2, they don't want you to have the full 180 to look at every property that you want. They want to constrict you in terms of time. And they're basically saying, look, by the 45th day, more than likely, you're going to have to limit your search down to 3. Because, again, 95% of people use the 3 property rule. But the goal, as we stated earlier, is to be done with the file, right, by the 45th. And I do get a call. I'll have to, all right, I'm going to be coming up on a couple, but I will leave you with, is a 1031 an all or nothing, or what are some in-game strategies, right? No, it's not an all or nothing. So if I sell for 500, I buy for 450. That's a perfectly valid 1031, right? I've deferred all but the 50,000, which we call boot, which I don't know why we call that either, but that's since I've started, I think probably for the last 100 plus years, because 1031 was created in 1921. Partial exchange, we reference boot. Now, how does that boot taxed? It's fully taxed. So there is no maximum with a 1031, right? You could sell for 500 and buy for 5 million in theory. But there is a minimum. You got to cover the original adjusted basis before you begin to defer. So that's kind of how it works, right? The adjusted basis rolls into the property that you're buying. So if my adjusted basis is 200 and I sell for 500, I need to buy for at least 200 before I begin to defer. If I buy for 250, I deferred 50,000. If I buy for 300, I deferred 100,000. If I buy for 600, how does that work? Well, for the first 500, right, the original 200 carried over, and then because I bought up by 100,000, that gets added on. So my carryover basis is 300. That's all it is, right? If I buy for $1 million, my carryover with the added basis is 700. That 300 gain is there no matter what. So if I buy for 450, yeah, I'm going to still pay tax on 50,000, but that's better than paying tax on 300, right? I'd probably pay around 15,000 of tax, or 12 to 15 versus 72. So people unwind, I would say, from a 1031 by, cashing out when they're retired, treating it like a 401. They've built up their money. Now they're going to, sell off. Maybe they have 30 properties in their portfolio. They sell off one at a time and they take the hit and then they, go travel and vacation, right? Some people will do partials over the years, kind of spread out the tax, almost like seller financing, take a little bit each year, but defer the bulk. Some people do end up buying their forever home or a vacation home, right? After a couple of years, you can move in or treat a 1031 property like a pure second home. I think most people, and this is a good way to end, I think this first one, right? We might have another one, but I think most people try and defer till death, and then they leave it to their heirs for the stepped up basis, right? When an heir receives a property, they're entitled to get an appraisal on that, and whatever the appraised value when they receive it, inherit it, would be their cost basis. So using my scenario, right? I buy something for 600. My basis is 300. I die. My heir receives it. The heir gets an appraisal. The appraised value is 600. If they decide to sell, if I sell for 600 and my basis is 600, what do I pay in tax? Well, the answer is zero, right? We call it swap till you drop, for lack of a better term.
That's the ultimate end game.
It
is you defer it until death, and then somebody gets a real benefit.
And how do you conceptualize that? Well, that's building generational wealth, right? That's the American dream, right? Or maybe what it once was. You're trying to leave your children or heirs in a better position than you. You're trying to, grow that family wealth, and that's why I think a good number of my best clients are some first, second generation Americans, because they kind of get it. They understand. They're trying to build something for their future generations as well, for sure. Well, I think we were going to a scenario of one. I had a call that I pushed, so I wanted to give a couple more details in terms of, if I were doing my first 1031, what would I want to know, right? I would say the biggest thing is if you can get flexibility on the property you're selling, that's huge. Now, what does that mean? I mean, one, it might mean having a good realtor, right, that has good contacts, good connections, be able to communicate properly. I've seen a lot of sellers, buyers, they just it's almost butting heads, and there's no flexibility. Having some flexibility is really kind of crucial from a success standpoint in a 1031, because again, the number one reason an exchange will fail is the 45. It's not the 180. No one has much issue with the 180. It's the 45 that you have to locate that will kind of make or break a 1031. So, having that flexibility on the sale allows you to basically lock up the purchase, make sure it's a good purchase. You go through your own inspection, and then the goal really should be to sell and buy within the first week and just knock out the 1031. So I would say that's the biggest thing. The other things I would say is you are allowed to take money for yourself at the sale, at the closing, if you want. Some people know they're going to pay tax on a portion of it, and they decide to withhold some of the funds. I've seen people sometimes withhold too much, in my opinion, because once you touch it, even if you change your mind, it will be taxed. So you're better off, in my opinion, to put the full amount in the 1031. Now, that doesn't mean you have to spend it all. It just keeps your options available.
Just delays the time that you will get it back if you don't
Well,
spend
an
it
example would be, if you sell for 500, let's say without a loan, you could just put in 400 if you think, I'm just going to buy something for 400, right? Or you could put in 500 with still the understanding that you're only going to look for something in the 400 range. But because, as we both know, things pop up, for, let's say, 500, or you decide, right, that you want to buy two properties for 400 each, you're going to probably thank yourself that you didn't decide to take out money associated with the sale. Again, it's perfectly allowed, but, once you touch it, even if that 100 that I take for myself, I end up using that, because I did find a property for 500, I would still be taxed on that 100,000. Vesting is big, so I can't tell you how many people don't understand how they own their properties, or they so if you own it in a multi-member LLC, well, you actually don't own the real estate, right? The LLC owns the real estate. So if you own a property with other partners and you're trying to look ahead, I can't tell you how many people don't look ahead. You need to start planning for that now. If I were the czar of ownership, I would try and start convincing people to own their properties as joint ventures rather than just one big entity. So I'm not saying you can't own your portion of the property in your own LLC, but instead of one LLC with, let's say, 3 members, there's 3 different LLCs on title where each person is the sole member.
Right.
And if you own it the latter, you each have the opportunity to do your own exchange or to cash out. Like your decision isn't dictated upon someone else's decision. But every week I'll get calls of people that own properties with other people, and that causes a lot of problems. And there are ways to get around it. It has a lot of risk. I'd probably throw out that scenario as, you'll get my contact information, I'm sure, or I can give it now, right? But you can just give me a call to discuss those options for you. So ownership is key. Like if you own it in a trust, well, we'll need trust documents, right? And that, even if you don't do a 1031, the closing company will still need those. So it's good to have, a little bit OCD when you have a bunch of real estate, and maybe have like I would probably have an Excel spreadsheet that outlines how I own each one, right? I would have all like a nice nifty folder with all of my organizational documents. So a lot of people have very large trusts, but they have never taken the step to upload it in a computer. That's like a recipe for disaster, right? You're one fire or just forgetful moment away from, I've had people have trust form 40 years prior, and I can't tell you how much money they've spent trying to like either redo it or come up because they've just completely lost it. So, it's best to upload a lot of your information. Now make sure it's secure, right? You don't want to be a victim of identity theft or anything like that, but have a USB drive with information that you keep in a safe or something would be ideal. Because we'll need ORG docs. When someone does a 1031, we need their driver's license. We need like operating agreement if it's an LLC, or a trust agreement. I would probably, if you're a little bit older, recommend you take a class on like DocuSign, right? Because whether you like it or don't like it, that is pretty much the way we're going. I'm probably need to tell myself this, that, AI is not going away, even though I don't necessarily have the best opinion of it. I think it's going to probably take a lot of jobs and cause a lot of confusion. But it is here to stay. So, becoming fluent with that language, it's all a various technology is basically just another language. So it's always best to keep up. So, as an investor planning ahead, become more tech savvy. I think that's going to help you, find your own properties. I mean, AI can be a beneficial tool to use in combination with experts. I would say, know how you own your properties and get a game plan. Like, okay, you want to buy in Alabama, what part? Are you open to different parts? Are you open to different types of properties? I think a lot of people get pigeonholed on a certain asset class of real estate. Again, the 1031, as we now know, is pretty wide open, and be willing to compromise would be my last piece of advice. Like, I've seen some people like just be so adamant to find the perfect property. Potentially, I don't know if there is a perfect property, that they take too long, and the person they're trying to buy from goes with somebody else, right? Or so 1031 to a degree is about saying, okay, I can either buy this property that might need a little bit of work to it, or I can continue to see what's out there with the risk that I run out of time and now I have to pay X amount of tax. Or if I buy a property for 400, should I take the 100,000 as boot, or maybe look at a residential lot to make up the remaining 100,000, right? I could park the remaining money in something that's, I don't necessarily, or leverage it, right? I think a lot of people are saying, "Oh, I miss the interest rates of 4 years ago." Well, yeah, because those are almost like fantasy land rates. I doubt we're ever going to see them again. If you did lock up your 2.25 or 2.5,
right?
Congrats. Now, that doesn't necessarily mean like, okay, if you have an investment property with a very low interest rate, but it's becoming stagnant from from a management standpoint, right? You're not getting tenants in, or you're not getting the rent you want. Sure, your cash flow is good, but maybe you could buy in another area, and that's going to have significant growth, where yes, you might, lose out on this loan. You might get a loan with a higher rate, but you also might have much more opportunities for significant growth. I mean, I can't tell you how many clients I do work with that when you initially pick up the phone, they're either, have a very thick country accent, then I think that's the benefit of growing up in Alabama, even though I don't have an accent
Careful
myself.
where you're going here.
Right. Yeah. Even though I don't have the accent myself, I can understand it. Right. And I can, But basically where I'm going is you would be surprised at these people that you wouldn't think, oh, they must not be sophisticated. They must not have, X amount. They have massive portfolios, vast amount of equity, and they'll smile you to death, but they're cutthroat, right?
Mm-hmm.
And so
Shrewd.
yeah, no, they're savvy, right? And so just but a lot of those also they know their strength and they know their weaknesses, but they're also kind of flexible in that regard, and they usually, those people have very good game plans coming in. Mm-hmm. So whenever someone calls me and they don't even have a property on the market, I tend to think, okay, that's not a waste of my time. That's actually somebody that's, when they do a 1031, it's going to be a really easy one, because the people that call me while they're closing, which happens, right? And we get those done, by the way. So if it's day of closing, we can still get it done. But if you're going to fail, it's going to be because of lack of preparation, for sure.
Yeah, I think the 45-day identification period is probably the biggest pitfall. And 2.5, 3 years ago, I would not have allowed someone to sell their property without having properties identified and agreed to yet. It was really tough. Inventory was incredibly low. Days on market was incredibly low.
Sure.
And to expect to get properties identified within 45 days after close, it was just impossible. Now you have some negotiating there. Days on market are a lot higher. They are here in North Alabama at least. And inventory is a lot higher. And you have some options where you can actually sell and identify properties within 45 days. But you got to be really careful about that. And
sure.
Ideally, like you said, you would sell and you would purchase within 2 weeks of each other. That's the best scenario. That's probably the biggest pitfalls, is going into it without having properties identified already.
And sadly, it becomes addicting. So when someone does their first exchange, you're going to end the exchange thinking, what did I really do? Because I didn't get to see any of that money from the sale, right? So it's, I bought another property. Oh my gosh, now I bought 4, right? I sold in Denver. Now I got all this headache. Well, what you did is, come next April, right, when you get your, you're filing your tax return, and you deferred all, X amount of tax, that's going to feel pretty good, right? It's going to feel pretty good seeing the potential cash flow of having 4 different properties where, like you said, if one of them is unoccupied, that doesn't, cause stress, right? You have that flexibility. And what you're really going to do is you're going to say, well, I got another property in Denver, and I need to call Luke about that again. And you'll blow up my phone, almost everyone does.
Well, there's no other way to grow a portfolio as fast as you can with a 1031 exchange. There's nothing else that exists.
Of course, you're talking to someone completely unbiased, right? Because this is all I do. But I mean, if you just look at the simple math, using our simplistic example, if I have 500 versus 428, which one am I gonna come out ahead on, right? Now that's not to say that you should buy for the sake of buying. So that, going back to Luke Hayes as if I were the exchanger, as we call him, the last thing I would say is attempting a 1031, as we discussed, doesn't lock you into anything. You don't want the tax tail to wag the dog, right? Another old saying. So if you give it a shot, you see what's out there. Now, I'm always inclined to say give it a shot, right? And again, you could say, well, they get paid at that point. But I've just seen too many horror stories not to say give it a shot. But sometimes the best outcome is just to take the hit, or the best outcome is to do a partial 1031. So, not having a successful exchange shouldn't be despair. I think there's things to take away from every exchange you do, because it is a deferral, right? Now you want to try and take it to death, but sometimes a reset. I've had people just life circumstances come about, or they just didn't find the property that was the fit they wanted. So I guess I'm kind of covering in both sides here, a little politician in me as well. I'm saying, well, you want to be open to properties, but you also don't want to just buy for the sake of buying. And I think that's where, having reliable resources, right? Like yourself, in terms of a realtor and somebody that knows what they're doing. You're not going to know all the answers. The first 1031 will have a degree of intimidation. But that's why you want to use an expert, someone that knows what they're doing, and have really, multiple sources that know what they're doing, and trusting your counsel to a degree, right?
Mm-hmm.
Trusting the people you surround yourself, and usually you're going to see the significant benefits because one last old saying, they're not making any more of this
That's
real
right.
estate. They're making pretty much everything else, right? Dollars, new types of investments that we've never heard of, but it's kind of the standard. It's the gold standard almost of investment, maybe besides gold, but and it can be powerful. And my side job will be to fight to keep it intact, right? And it's over 100 years old, so it's not a loophole. I remember last year I was at, I think, like a Halloween party or something, and there was a financial advisor, and he was just so stuck on the fact this is a loophole. I was like, anything could be a loophole. The whole U.S. tax code, when used correctly, is a way of, as you said, right, tax avoidance.
Right.
But it's legal and it's allowed. Why would you not take advantage of it? But from an industry standpoint, 1031s is the kind of the centerpiece of commercial real estate. We have strong relationship with the Ways and Means Committee. We have strong relationship with. I made a joke about our representatives, but a lot of them get it. A lot of them are doing their own 1031s, right? I think if you're investing in real estate and you're not at least looking into 1031s, you're doing yourself a disservice for sure.
Yeah, and I want to echo what you said about vesting. That's another, people put things in a partnership with 2 to 3 partners,
Right.
And then it can make it very difficult to grow that portfolio through a 1031. So be very intentional about how you form an entity with the
Correct.
expectation that you're going to grow. A lot of people also don't think they're going to grow. Everybody does, and everybody's going to want to, but it can be very
Well,
challenging.
I would also say be careful of who you invest with
that
as well.
too, because
Yeah.
the entity can exchange, right?
Of course.
An LLC can exchange for other real estate, but like you said, the individual members of that entity, not so easy.
That's right.
So be
That's
very intentional about how you form your entities
Right.
and who it's with, and whether you intend as an entity to grow or to grow separately at some
Well,
point. I
and
think
to
that's
dovetail
something.
that, again, going back to what I would want to know is get your wills in order, you get your estate planning in order, because a 3-member LLC is difficult for all the parties to come together, but it's not impossible.
It's hard with 2. It's really hard with 3.
It's impossible when the heirs when there's now 6 kids that own the 1/3.
Right.
You're stuck. You're not going to be able to do much in that regard. So, yeah, I would say 1031's what we haven't really touched on is an estate planning tool, right? I've had people buy properties that, instead of leaving one big farm to 3 kids for them to bicker and fight over, you buy 3 different properties and leave it to each of the kids. So now when the kid gets it, it's their property. They don't have to worry about their siblings. If they want to sell it, they can sell it. There's no one that's going to block them. If they want to keep it, they can keep it. So I think that's a great strategy, is not just to leave the whole pot, the whole real estate portfolio, where each child receives an X amount of undivided interest, but actually give each of your heirs the full property, because it's just easier, right? And it's a little bit difficult to mix and match. And yeah, someone might come out slightly ahead or slightly below, but if you have multiple properties, get your estate planning in order, and get a good CPA, right? That's probably the last thing is pay that extra, right? The 1031 is the filing. The form is an 8824 form. It's not fun. I promise it's not fun. We provide an accounting statement, which kind of assists you or the CPA of filing it, but, or using, TurboTax, whatever. They have advanced methods. So yeah, it's not.
So we know we can exchange one property for multiples. Can you exchange multiples for one? If you want to sell multiple single families that are in the same entity, can you do that and exchange it for a commercial property or just a piece of land?
You can. It's difficult. I would say it's much more difficult than diversification, because all the sales have to close before the big buy. So, you're gonna have to line them up. I've seen people do about 3 or 4 into one. I think more than that, it's easier just to do another 1031 and maybe do it in phases. So if you have 12 properties, instead of going from 12 to 1, maybe on your first exchange or year you do exchanges, go from 12 to 3, right? You do 4 to 1, 4 to 1, 4 to 1.
But if the timing is arranged the right way, there's nothing to prevent you from
there's
a
not
dozen to get one.
But the 45-180 is maybe the prevention.
Yeah.
The timing itself, I would say, is the prevention. Because you also don't want to be rushing and sell your property maybe at a lower value to try and fit it in. You know, I think you're always better to just buy another property, you know, because I'm pretty bullish on properties in general. I still think so. Yeah, no, it's absolutely, people do all types. So one for multiple or multiple for one or multiple for multiple. You can kind of mix and match as much as you want, but there is certainly the timing component that needs to be factored in.
Okay. Well, Luke, we've covered a ton today.
Yeah.
I appreciate it.
You get another 2 hours of CE credit, right? Yeah, no.
If only. What's the best way to get in touch with you and your company?
Yeah, my direct line, it's a work cell, so I have people are afraid to call me on this. Trust me, I'll put it away on the weekend. Most of the time, I say, but it's 629-203-2725. So it doesn't have a catchy jingle, unfortunately, but we have our toll-free line, which usually will get to me. That one's 877-494-1031, so that has the 1031. But, 629-203-2725, and then my email is Luke, Luke.Hayes, Hays, no E, at IPX. So I for Indigo, P for Paul, X for X-ray, 1031.com. Okay. You Google me, I'll probably show up at this point. So we have a great marketing team at IPX, and I do a lot of classes mainly for the reviews, right? I have a pretty high review count. I will brag about myself. It's the highest in our company. A couple of 4 stars, which breaks my heart, but it is what it is. But we have a website. Our website is fantastic, ipx1031.com. Tons of articles, tons of information, calculators. So, a capital gain estimate, a 45-180 calculator, right? If you don't want to, there's videos, there's 5 to 10 minute videos. I'm probably going to steal this podcast, and I think our marketing team put our own YouTube page up. So we're starting to, make those marketing touches again, trying to get digital with everything. But yeah, you might see this podcast on my own website. But
perfect. Well,
the only thing I will say though is the photo of me will be a clean shaven man in his 20s, and now you're looking at a grizzled veteran in his early 30s. So I probably need to update that soon. I've been holding off.
He dresses like Steve Jobs.
Yeah, that's right. I think it's a pretty good look for me. But no, I really appreciate it. This has been fun, and I would say kudos to you. Most people don't know what questions to ask, and you've probed excellently to get, I would say, the nuances of it. And I'm probably gonna check out your other podcast and learn some stuff myself. Right? Yeah,
well,
absolutely.
I've been through the 1031 multiple times.
Sure,
it's always worked out.
Yeah,
and there's no, for any investor out there, this should be their first listen. You're going to want to know how to grow.
I'm moving right to the top.
If you don't think you will, you may be. You may hurdle all the others, but nobody thinks that they're going to grow that fast, but you will.
Sure.
And you'll want to.
Sure.
And this is very important. And you never lack for giving information, so I really appreciate it.
I try not to. Yeah, sometimes I overtalk. So yeah, absolutely.
Luke, good to have you. Really appreciate it. Luke Hayes, look him up. IPX. I'm JD. My time's up. I thank you for yours. This podcast is proudly sponsored by 256 Realty, investors helping investors. Visit us at 256realty.net. Big thanks to our production team at AVO Multimedia Services for producing, editing, and providing the music that brings this podcast to life. If you enjoyed this episode, be sure to subscribe or follow the podcast on YouTube, Spotify, Apple Podcasts, Amazon Music, iHeartRadio, or whatever platform you choose. We'd love it if you'd leave a comment, review, and rating. It really helps us grow and continues to bring you valuable content. And of course, don't keep all this knowledge to yourself. Share this episode with a friend who's ready to level up their investment game. To catch more episodes and video content, visit our YouTube channel at 256 Investor.